Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. We've been discussing a series almost all year long about one of the most devastating situations that I can find that impacts retirement, and that is health concerns of living too long, which leads someone to requiring advanced care, either someone coming into their home or the person going into a nursing home. It can be devastating to what otherwise was a lifelong success story of financial management, where the parent or senior had done an outstanding job navigating through all the turmoil, volatility, difficulties, inflation, debt reduction, debt management, Social Security, income management, did everything right for all their years, over 80 years maybe in some cases. And then in just the last few years of life, simply from possibly living too long, finding over the last 3 or 4 years, the trailing years of their lives, draining some or all of their assets, wasted to a nursing home, where the parent or grandparent or yourselves or the spouse, I consistently hear, oh, what a shame. Oh, my goodness, what a shame. But you know what? It's becoming predictable, folks. You know, back in the 70s, it was the exception. The exception to the rule now, this is 2015, for the next 20 to 30 years, the exception to the rule now will be a married couple going through their retirement years and one of them not going into a nursing home. Back in the 70s, the exception to the rule was of every married couple that one of them would need to go into a nursing home. So I'm seeing it, folks. I've been in business almost 40 years now, since 1976. I have actually gone through retirement almost 4 times through all of my clients cycling through this business. My relationships over 4 generations of seniors entering retirement, living through retirement, dying, and the next generation through my career coming into retirement, living through retirement, dying. And when you get into about 40 years experience like I have, and every 10 years a cycle of retirees comes through, you learn a lot. And you realize you don't have to go through retirement your own self to experiment and figure this out yourself. With my experience over 40 years of hundreds and in fact thousands of retirees that have gone before us, and I've watched them full cycle over 4 different cycles and generations of retirees, I begin to recognize patterns. And part of the reason I am doing this radio show is because I have so many different generations of financial planning, of people that were in their 20s and 30s and 50s and 60s and 80s and 90s, cycling through over and over and over again. I have a lot of experience I can share over the radio and through these videos so that we can, number one, learn from the successful people and what their habits were in the past and repeat them, and learn from the mistakes of people that have followed before us in the past and choose to not repeat those same mistakes. That's the purpose of learning, folks. Not repeating the same mistakes, but learning from them and avoiding making the same mistakes. Well, I'm here to tell you my most difficult component in all areas of financial planning is how do I solve this problem that all seniors will face, and that is the risk that we may or may not need to go into a nursing home. And if we do, the financial consequences may be devastating to our finances. It may wipe out our savings and our assets, and it might wipe out our spouse if, in fact, we cut down our assets and our income too much below where they are now. Because as you all know, folks, in retirement, most of us don't have far greater assets than we need and could afford to lose 50 or 60 or 70% of what we have and get our income cut in half, and we'd still be okay if we're the spouse at home and our other spouse is in a nursing home. So we need to wake up here, folks. We need to realize the risks. We need to not repeat the same mistakes that we're seeing other people getting their finances wiped out if it's preventable. And it is preventable. So the purpose of this series since the beginning of the year has been to show you there are many, many different solutions. It's not just buy long-term care insurance. It's not just buy life insurance and replace the assets. It's not just have kids come in to take care of the house, take care of the family. It's not move in with other family members. It's not just do nothing. Take me out in the backyard and shoot me, everybody says. It's not any one of those things. It's the combination for every family and every individual to sit down and evaluate all of the possible alternatives, including seeing lawyers should we make arrangements to protect certain assets or not, and the feasibility of trying to qualify for VA benefits and aid and assistance, aid and attendance. These types of planning strategies exist in advance of the need, and they are exhausted or expired at the time of need. So that's why I'm putting out this series, to help those of you who want the help and recognize the problem. Again, I can't help everybody. I can just share the information. So what I've done is where we are, the stage we are right now, I am in the segment of how to shop for long-term care insurance for those of you who are looking at the possibility of long-term care insurance and don't know how to look for it or even what to look for. So we're in that stage, and I was sharing with you a survey by Brokers World magazine on going through the consistent, maybe common types of coverages. What is everybody else buying who's buying long-term care insurance? What type of limits? What type of time frame? What type of deductible? So if you listen to my past shows, you'll get all caught up on this to where we are to date. So I'm going to continue on this survey, and I'm going to help share some things that if you're shopping for long-term care insurance, you want to have a pen and paper and you want to write these down, or if you're in the car, you want to go on my YouTube channel and you want to listen to them and write these different points down. So if you're shopping for long-term care, you're a little more educated as to and knowledgeable as to what to look for and what are some of the alternatives. So let me get on to the next step, picking up where we were before. When you're shopping for long-term care insurance, you shop for a specific amount per day. And we talked about this last week. Are you better off to buy $100 a daily benefit, which is $3,000 a month toward a nursing home cost, or $300 a day, which is $9,000 a month for nursing home cost? Well, there's another factor after you choose the daily maximum. And that is, once you pick that limit, today's average cost in a nursing home is maybe $9,500, let's say, for a month for skilled nursing care. So let's say it's a little over $300 a daily benefit. So if you buy $300 a day and you're 60 years old, by the time you're 80 or 85 and maybe need the coverage, if you still have $300 a day, you might only be covering 1/3 of the then cost per day in a nursing home. So what we want in many cases is to evaluate adding an inflationary protection rider, which says there are a number of different riders. The first one, and most common one used to be, although it's getting expensive, was the 5% annually compound increase rider. And what that rider did, it went through, gave an increase. You'd go on your computer, you'd go on your calculator, you'd come over here, you'd click, 5% increase. What would it do over 5 years? What would it do over 10 years? You'll see that the 5% increase might double the benefit over maybe around 15 years period. We could do the math. But the key is trying to help keep pace somewhat with inflation. Well, there's a price for that rider. So some people say when we add up all these premiums for long-term care insurance, they're too expensive. So we compromise some of the coverage options. And one of the compromises that a lot of people are making, I'm not saying it's right or it's wrong, but to try to hold these premiums in check, are to change and maybe purchase a 3% compound annual increase rider in lieu of a 5% compound. And then there are other riders with some companies, a 5% simple increase. That would be if I bought a $100 a day benefit. The increase rider would say, we'll go up $5 a day for each year. So it'd be $105 a day the second year, $110 the third year, $115, and it's only a fixed $5 every year because it's 5% simple increase based on the initial amount. 5% compound increase is 100, then 105, then 110.5, and then 116, something like that. It compounds upon itself 5% growth, including last year's growth. Same thing with the 3% compound. So you can buy with some companies 5% simple to help reduce the endorsement premium because you're buying a less quick or fast rate of growth. And same thing on 3%. Some companies will give you a 3% simple. And then you could buy a policy with no inflation rider. So there are risks there that you could do. What we're finding is last year, this survey points out, this year, which is in between 2013 actually from 2012, because by the printing of this report, by the time they printed it, we did not have the 2014 results yet. But it dropped. The number of people that bought the 5% compound rider dropped about 32%. So a lot of people stopped buying the 5% compound and backed off. The interesting thing is the percentage of people that purchase policies with no benefit increase feature, it says it dropped, but the percentage with a deferred compound option, and what that means is you can buy a policy with some companies saying, I don't want to buy a compound rider now, but I want to buy a rider that's not expensive that I can trigger or activate in the future, a compound growth or a simple growth rider. So some of those people bought that deferred option that used to buy the 5% compound and would have bought the 5% compound, but the prices are going up so much. Why are the prices going up so much? Folks, listen. When we pay a homeowner's insurance premium, we might have a $200,000 or $250,000 value on a home, and the homeowner's premium might only be $800 for the year. $60 or $70 a month to protect the whole asset. When I buy long-term care insurance policy for that same risk, covering up to 3 years if I go into a nursing home on an individual health situation, and maybe that total amount of money that the company would pay over the 3 years, the coverages I'm buying would pay $250,000. That coverage might be $300 a month. That's $3,600 a year. Why the difference? Can you guess? Insurance companies charge a premium based on the types of claims and amounts of claims and the severity of claims, which means how much they have to pay. They charge a premium commensurate for what the risk is. it's very unlikely our homes are going to burn down. The insurance premiums are telling us it's very likely we may need to use that coverage. They have to charge more money for it. With a home, if it burns, the insurance companies get to use 500 other people's premiums to rebuild our home. Excuse me, because that may be the risk. Nursing home, it might be 1 out of 3. So let it show you a sign when you're looking at these endorsements and these endorsement riders, when you're shopping for long-term care. When you see one endorsement and you see an inflation guard, and it's a super expensive endorsement to add, and you say, oh my goodness, I'm not going to add that. Think. The premium is hitting you on the head saying, this one we have to use a lot of. And if there's another rider on a long-term care insurance policy and it's not expensive, think. That indicates this endorsement, they don't have to use much, or it's not very expensive for the company if they do. In other words, it's not a large maximum benefit. And I'm going to share something with you when we go through this with this premium. When you factor all these different premiums together like this, these additional premiums, when you factor in, I want a lower elimination period, not waiting 90 days, but maybe 30 days, or I want a higher inflation protection. Factor something in here, folks. If you look and can afford the first 2 or 3 months, and that same amount of premium, instead of shortening the elimination period, buys you a whole extra year or 2, and let's say the price is the same for the 2 endorsements, see which one's buying you the most amount of money. But you have to offset that with the risk. If you're buying coverages for in the 4th year or 5th year that you're in a nursing home, the odds decrease the number of people that will be there in the 3rd or 4th or 5th year to collect those benefits, where the first 90 days, the odds are almost 100% that anyone making claim for benefits will need the first month paid, the second month paid, and the third month paid. So that option is very expensive. You might be able to buy a whole year's worth of benefit, extending it to a whole year for what adding only 2 months upfront costs. So watch for that. Look for that when you're looking for these riders. All right, now, there's a future purchase option rider. And what that is the ability to buy additional coverages or additional amounts of coverage in the future. So what you do is you buy a rider now, and it's a fixed rider, fixed premium rider. And it's on your policy whether you exercise it or not. But it allows you the ability at a future point to add coverages or buy additional amount of coverage at a fixed rate because you bought the right or an option to purchase additional insurance in the future. So that's a rider you can look for if you think you can't afford it all now, but might be able to afford it all in the future. Some people will say, well, I think I might be getting an inheritance and I might be able to afford it better in the future, but I can't afford it now. When you're shopping for long-term care insurance, I want you to be careful of something else. If you're age 60 and shopping for this, and remember I talked a couple shows ago, age 55 to 58 is about the average years that people shop and buy long-term care insurance. It's because that's the sweet spot of the maximum benefits for the acceptable premiums that a person can balance. So when we're looking at that and you say, well, I think I could afford this much, I want you to project this premium that you're taking on for each you and your spouse. You're still going to be paying that premium at 75 when you're on fixed income. So I want you to build these policies based on your retirement income and the ability to pay for this in retirement. That brings up my final point for the day, and it's important. For those of you who have calculated your retirement income, or are already in retirement and living on your retirement income and cannot afford any premium or any additional expenses, I want you to look at the assets. The reason a lot of people are buying long-term care insurance is because they have assets they're trying to protect. If you have $500,000 worth of assets that you're not touching for your retirement income, or you're partially touching, but there are earnings or interest available that you're not utilizing, why not have your assets pay and buy the long-term care insurance out of the interest earned on the assets? Speak to your assets and say, hey, you're what I'm trying to protect. The $500,000 so that you don't get lost. If I go into a nursing home, you pay for the long-term care insurance to protect yourself, your assets. And let the assets pay $250 a month or whatever the amount is out of the assets, not your income in retirement, but have the assets structured to generate enough income to pay the premiums so that your retirement lifestyle is not impacted. If you look and you have $500,000 and long-term care insurance is $5,000 a year for you and your spouse combined, folks, listen, that's 1% of your assets. By giving up the first 1% every year of your assets, and you speak to your assets, you say, hey, assets, if you can't give up the first 1% of your assets to protect against, or at least help protect against losing all the rest, how in the world can the assets afford the risk of possibly losing and getting cut in half in even over a 3-year period or a 4-year period 15 or 20 years from now, when nursing homes cost $20,000 a month, which right now they cost $10,000 a month? Folks, wake up to this. This is real, and it's happening all over. Many families that are listening to the show, you know somebody who's 80 or 90, and you know people in nursing homes. You know I'm not making this up. Come on. Use your heads. Be responsible. Think toward the future. Solve this problem. Live a much happier and stress-free retirement lifestyle. Solve this problem today while you still can, and you will live, I believe, a happier lifestyle in retirement than if you continue to have this burden around your neck, this noose around your neck that you continuously have not solved, and simply hope it never happens to you, which is not a plan at all. All right, folks, I'm going to come back next week and share some more ideas on how to shop for this insurance. And again, it's not the only thing we'll do. After I'm done with the insurance, we'll go on to other alternatives on how to solve this problem. We'll just spin the wheel. There are lots of solutions. I'll help guide you through all of them for this long-term care management crisis in retirement. We'll be back again next week. Thanks for tuning in.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.